Welcome back to All Things Money. I'm David Blain, and during this segment we're going to answer some viewers' email, but before we do, we'll go through our obligatory contact information. If you have any questions or comments or would like us to address your question on the air, please give us a call at 252-633-0107. Our email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. Or you can always visit us on the web at www.dlblain.com. And there you'll find archived copies of the show. If you missed the first couple segments, we'll post it there in a week or so, and you can hear what we had to say. So our question today comes from a viewer, and they were asking about picking stocks. They said that they've been picking individual stocks for years, and they just don't seem to, none of the things that they do seem to work anymore, that they look at the earnings and the fundamentals of the company, and it doesn't seem to make any difference. Well, this is a great question because it applies directly to what I've been doing and what we've been doing in our firm. When I first started managing money back in 1987, we used all individual stocks and bonds, picking Coca-Cola, Microsoft, Home Depot, Cisco, individual companies, looking at their earnings, their growth rates, their debt levels, their fundamentals, and trying to figure out which companies we felt would be better selections than average for the long term. This worked out very well all through the decade of the 90s, up until the year 2000, when the bear market hit. We saw virtually the majority of companies go down in unison, and somewhere around the mid-2000s, we noticed a very disturbing trend that that companies started moving together more and more, that there was not as much divergence among the individual companies. Now, there was still some divergence at the sector level, like if a company was an energy company or a technology company, or even at the industry level. Was it a semiconductor company or was it a food company? But at the individual stock level, what we saw was that there were the macro forces, what we call macro forces, broad economic trends, things happening at the country level, at the global level, were having more and more influence on the individual companies. And so over the past several years, we actually have moved away from individual securities and now use almost exclusively what are called exchange-traded funds, or ETFs. And these are baskets of securities. For example, instead of trying to pick between Exxon and Chevron, let's say you think that the global energy problem is just going to continue and the oil companies are become more valuable. Well, you could go research Exxon and BP and Chevron and all these companies and try to figure out which one was best and buy that one. Hopefully you didn't, it wasn't BP and you watched a lot of the value evaporate. So what an exchange-traded fund does is it says, okay, well, we are going to acknowledge the fact that markets are largely efficient, and we're not going to try to pick between Exxon and Chevron and BP. We're going to put 20 oil companies in a little basket together called an exchange-traded fund that you can buy and sell like a stock. So when we place an order for the energy ETF, we instantly own a portion of 20 different energy companies instead of trying to buy figure out which one is better than the other. So that's kind of the background. Well, on Monday's Wall Street Journal, Tom Lauricella and Gregory Zuckerman wrote a great article in the Wall Street Journal called "Macro Forces in Market Confound Stock Pickers." That's a great title to the article. And so this directly addresses our viewers' question about picking stocks. And they go through the article that there are stock pickers out there. They interviewed a gentleman named David Pedowitz from Neuberger Berman, and he says that they typically buy and sell stocks based on the research of the individual companies, and that his investment strategy has been upended by a tidal wave of macro forces, big picture market movers like the economy, politics, regulation. These type of things are overshadowing, and more investors aren't bothering to pore over, annual reports and studying the fundamentals of the company, because all kind of stocks, good and bad, are tending to move in lockstep to one another. Now, I take that one step back, and I view it as entire sectors of the economy or industries are moving together, that there is still some divergence within that, but the individual companies are not. The data suggests that stock pickers are having a harder and harder time outperforming the market. Between 95 and 2007, on average, 50% of mutual funds focusing on large growth companies beat the Russell 1000 growth. In the past year, only about 24% of those funds beat that index. The stock pickers said that the macro forces started moving in a big way in 2007, 2008 when the financial crisis hit, and these macro forces of a hit on government, on corporate profits, government debt, contributed to the macro trend. Now, myself, the other factors, the rise of exchange-traded funds have itself contributed to the difficulty in stock pickers in beating the market. Exchange-traded funds now account for more than 30% of the daily volume of the market. And so when you have investors buying and selling baskets of stocks, it becomes difficult for someone to pick the individual securities. And you have to understand that on Wall Street, the big money still moves the markets. And if you're Warren Buffett and you can afford to sit on a company for 10 or 20 years or buy the whole company, which is what he does, sure, there's still some value in picking through companies and buying entire companies. But for the average investor, frankly, for the average Wall Street firm, unless you have some incredible genius picking stocks for you, it's becoming much more difficult to pick stocks. So now this may change in the future. The correlation among stocks may begin to recede again. If that is the case, we will certainly move back into using individual securities again. But for now and for the near future, we don't see that the additional risk you take on by trying to select individual securities compensates you for the additional risk, or the return doesn't compensate you for the additional risk. Well, that's all the time we have for today. For All Things Money, I'm David Blain. We'll see you next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.